Gold is just people panicking over the situation of things in the world and putting their money in something they consider to be a stable asset. Hello everyone. So today we'll be talking about gold. Now, if you've been following my Invest Engine portfolio, you might have noticed I made a slight tweak to my allocation. Now, I'm the guy that always tells you, just keep it simple, do 100% globally diversified ETFs. But then I like to tinker. So something I started doing recently, actually in the last couple of months, because I thought to myself, what could I do if there's a market correction, so to speak? It got me thinking about what are the ways that one could keep one's portfolio a bit steady. We know in the long run, 100% ETF portfolio still performs better than most other portfolio allocations. That's what history has shown. However, it's also the most volatile type of portfolio, right? Which is why people tend to also have bonds in their portfolio and other assets. Now, I personally do not like bonds because they tend to underperform in most situations. They keep your portfolio steady, but in terms of long-term performance, they underperform. And I've seen it in my own portfolio a few times when I invested in bond ETFs. But I decided to explore another asset type, which was basically commodities, specifically gold. So I did a bit of reading, tinkering with ChatGPT and other AI bots, as I like to do. And I came across two ways I could invest in gold if I wanted to. And I tried one for a period of time and decided to try the other. And I'll explain why. So the first one I tried now was iShares Physical Gold. And basically, if you read what it says here, it tells you that this ETC, so they call it ETC, which is a variation of an ETF. If we search what does ETC mean in investing, so ETC is exchange traded commodities. So this ETC provides investors with a way to invest in physical gold by following the daily price of gold. It does this by owning gold bars, so it owns physical gold, and it may appeal to investors looking to own gold in their portfolio. So it's a way to invest in gold without necessarily having to buy physical gold and store it somewhere. Now, I invested a bit of my portfolio in this, allocated about 10%. And then a couple of months later, I switched to another one, which was Invesco Physical Gold. Also, now this one says, if you check the description, it says this ETF is designed to offer investors exposure to the gold market while mitigating the risk of currency fluctuations. All right. So it also holds physical gold. It holds physical gold, but it hedges out the currency exposure to the British pound. All right. And it makes it suitable for investors looking for a way to invest in gold while minimizing the effect of currency exchange movements on their investment. It may appeal to those who want to diversify their investment portfolio with a commodity like gold. It allows investors to own gold without the need for physical storage, providing a convenient way to gain exposure to its price movements. Now, the difference between this second type of ETF and the first type is the second type is what is called a hedged ETF. So typically, because as at today, the United States holds the largest stockpile of gold in the world, a lot of gold ETFs trade in dollars. You may invest, if you're in the UK, you'll probably buy the ETF in pounds, but the underlying asset that the ETF is invested in, the gold, is traded in dollars. The implication is sometimes the price movements that you see on your ETF, on your pound denominated ETF, sometimes it's driven by the price of gold, but other times it's also driven by the relative exchange rate of the dollar to the pound. Now, long and short of it is, sometimes the price of gold may not move as significantly as the price of the dollar. So if we use an example, in the 2008 global recession, you had a lot of people rushing to buy gold, but aside the people rushing to buy gold due to the fluctuating stock market, a number of investors in the US that had invested in other countries like Nigeria also pulled their funds from emerging markets and brought them back into the US. What happened was the dollar got stronger because more people were now investing in US assets due to the uncertainty. So not just did the price of gold go up, but if you look at it from someone investing externally, the value of the dollar also went up. So it had a compounding impact. Now, the reverse also happens where the price of gold is going up, but for whatever reason, if the dollar is getting devalued and people are pulling their currencies away from the US, like we had earlier this year after Trump did all the interesting things he did with gold, you could have a situation where the price of gold is going up, but because of the reduction in the value or in the strength of the dollar relative to the pound, you are not getting that full impact in your portfolio. Instead, it's eroding the gains you're making from the price of gold going up. So that's where that second type of ETF that is hedged comes in. Now, I'm going to take a pause here and just say this because it's been ringing in my mind that I didn't mention it at the beginning of the video. I'm not a financial advisor, all right? You still need to do your own research, whatever that means. If you need financial advice, you need to talk to a financial advisor who will look at your own personal circumstance and determine what is most suitable for you. I'm just sharing what I am doing at the moment and what I think as a layman that has invested for 15 years, successfully, if I may add. Now, back to what we were saying. So those are the two ways you could invest in the gold ETF. And I tried the first one, which was just the iShares physical gold ETF, which was plain old physical gold, SGLN. And then I've moved that, my 10% allocation, I've moved it to the Invesco physical gold, which is hedged. So no matter what happens to the relative exchange rate of the dollar to the pound, it doesn't affect the value of my ETF. Again, there are pros and cons to this because there are times when that appreciation in the dollar actually helps your ETF as well. So it's not just the price of the gold, but also the fact that the dollar is also strengthening. And there are times when the reverse is also the case. So you may want to consider, do I want to bet on the dollar going stronger? And I use the word bet because when it comes to investing in commodities, I typically don't like it, and which is why I'm capping my investment in gold at 10%. One reason for that is it's basically speculation. There's no individual business around gold. It's a commodity, it's a raw material. There's no uniqueness to it. Gold in China is the same as gold in US, it's the same as gold in UK. It's gold. It's not like a business where you actually have a board of directors. You can do things to 10 times, 100 times, 1,000 times your profit. Gold is just people panicking about the situation of things in the world and putting their money in something they consider to be a stable asset. Which is why, again, I limit how much I put into it because it's also me kind of giving into the panic. And eventually, once this upheaval with the US settles down, I will go back to my 100% ETF portfolio. But I just said I should give you an update on what I'm doing, why I'm doing it, how you may consider doing it, especially in case you do check out my ETF portfolio on Invest Engine and you're wondering, why is Modupe now 90% stocks and shares as opposed to 100% stocks and shares? All right. Now, if you're interested in checking out my portfolio on Invest Engine, I usually leave the link in the description of my videos so you can check it out. One thing I also like about the way Invest Engine showcases it is you get to see the allocation of my portfolio, not just across the ETFs, but also across the regions, what parts of the world that portfolio. So right now, I've sort of reduced my allocation to North America, so it's only 46%. Meanwhile, if you check the Invesco All World, you see the split of the US within that portfolio is actually about 60%. So I've sort of dialed down my split and elevated my allocation to emerging markets, particularly China. Emerging markets is like 10% of my portfolio now, gold is 10% of my portfolio now, and North America is 46%. And then you can also see the allocation by holdings. You can see it by sector, that doesn't tell me much, but you can see it by holdings as well. and see right now 4.2% of my portfolio is Nvidia, another 3.6% is Microsoft, and then you have Apple at 3.5%. So you can see the companies that still form a huge chunk of my portfolio. So yeah, you can check it out. And if you do decide to open an account with Invest Engine as well, they don't charge any fees unless you want them to manage your portfolio for you. But if you do what I do and you just open a regular ISA and manage it yourself, which is pretty easy, honestly, you don't get any fees, any charges. It's free. And it's also tax-free because whatever gains or profits you make within an ISA account is tax-free, at least for now, based off what we know. But if you want to know how to open an account with Invest Engine and how to select an ETF so that you're fully globally diversified, I'll leave a link to a video here. Click on that and watch it. But for now, thanks for hanging out with me. Like and subscribe and do all the YouTube things, and I'll see you around.